You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody. That music means it's time once again for Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. Next up on the old network is a newcomer to the program and indeed to the network. He is Eric Metz, the CIO over there at SpiderRock Advisors. Eric, welcome to the Options Insider Radio program.
Thanks, Mark.
And Eric, as we are wont to do with all of our first-timers here on the program, why don't you give us a little bit of an overview of your background in the options space and how you found your way to SpiderRock?
Yeah, sure. My entire career has been in options and derivatives, kind of bouncing around the Chicago proprietary trading landscape before entering into the asset management realm with a firm here, again, in Chicago called River North Capital Management. Building out SpiderRock Advisors, I think is the more recent stint and why what we're here to talk about today. But largely speaking, the industry we felt had a void, and that void was scalable, customized, which sounds kind of like an oxymoron, but building out that prototype for institutions and advisors, is our main focus, and we're the fiduciary in the equation.
He spent some time, I believe, over there at the CBOE. What did you trade over there?
Sure. SPX at the CBOE, and then Eurodollar options over at the Merck with the firm Chicago Trading Company.
We had a guest in here yesterday. He spent the exact same bits, SPX and Eurodollar. I don't know what the...
They were the big ones.
They were the big ones back in the day. They were the big. What years were you in the SPX?
02, 03, and then 03, 04 over at the Merck.
Okay, we just missed each other. I was there from like 97 odd up until about 2001 out in the SPX, and then I switched. I didn't go to Eurodollar, so I never did the Eurodollar stint. Even back then, Eurodollar was just a crazy product to behold and a fun one. I'm sure a fun one to have stood in for a bit just to get the true crazy pit experience.
The adrenaline definitely was moving.
They had the different sections, I believe, for the different terms. It's a crazy product out there. Speaking of crazy products, let's get into all the crazy madness that's going on in the world of options. By the way, we gave a little bit of overview of you guys. You mentioned there's a bit of a hole you saw in the space. A lot of our listeners, this is the first time SpiderRock has been on our network as well. Give us a little overview there. What is SpiderRock? What do you guys do?
Yeah, sure. So SpiderRock Advisors is an asset manager solely focused on building customized derivatives solutions for our clients. Our predominant clients are institutions and large financial advisory firms. And it's built on the infrastructure and the chassis of the SpiderRock Holdings technology. So the largest differentiation in kind of the technological landscape between SpiderRock and some of its competitors is the ability to automate and put methodology and algorithms behind your trading. So a bunch of proprietary work by the founder, George Papa, to really extract and implement alpha strategies in the proprietary nature, and then we collectively saw an opportunity to build upon that infrastructure to support our business, SpiderRock Advisors, in delivering these solutions. And we call them solutions after we kind of ascertain the objectives of our clients and building that technology to appease their needs.
I know a lot of what you guys do is on the overlaid side of the space we're pretty familiar with it. We get into that space regularly on our network when there's our advisors option program. Actually, obviously, income and protection are two very big concerns for a lot of asset managers and advisors out there, but it's a very broad, a very many ways subjective space. One man's overlay is not the same as another man's overlay. So walk us through what types of overlays do you guys do? What's your methodology for overlays?
Yeah, sure. I mean, an overlay in its simplest form could just be a simple covered call. Our clients, let's just take that one example because it's probably the most ubiquitous and well understood. Performing an overlay of index covered calls on a portfolio of securities or basket of mutual funds, et cetera. For 10 accounts, not terribly difficult. For 50 accounts, feasible if you're dedicated full time. You try to get to 100, maybe 200, maybe 500 or 1,000 accounts. It becomes operationally too much of a lift for a lot of firms. So we fill that void, and the ability for us to do that with the precise nature is coupled around our infrastructure and our technology. So algorithmically putting in process, putting in rules-based systematic strategies, to deliver these trading overlays, so to speak, per account, per client, and various mandates. So a lot of science in the workflow and the technology, but a lot of art as to how to best implement them and interface with the markets.
Yeah, that's a frequent complaint we hear from a lot of the advisors and asset managers in our audience is that they would love to do, simple covered calls even for their clients. But you're right, you get into a few hundred SMAs, that becomes laborious to have to roll and automate that procedure. So it sounds like you guys see your opening there, helping them effectively, like you mentioned earlier, automate that type of process. Or if you're an asset manager out there, advisor, you have a bunch of SMAs. That's kind of where the niche you guys see yourselves fitting in, easing that process for them.
Yeah, so think of it as twofold, right? So if a team has, the investment and the derivatives competence internally, our job is to consult them as to how to maybe better do that. But if they're all set in their needs on that capacity, then, we can aid them in their scale. There's another crowd that says, I know enough to be dangerous, but I'm not I don't have the expertise internally here, so I need you, SpiderRock Advisors, to fill that void. And then whether or not I need that and scale operationally, or I just need kind of the outsourced CIO mindset for, the niche asset class, that being volatility, they can pick which direction they want to utilize this in.
And are the bulk of your clients using the overlays, are they just in the basic covered call? And do you guys offer, more advanced, obviously the collar and different types? What types of overlays do you guys offer?
Sure. So, we've built the business really out of client demand. And largely speaking, there's only so many ways to skin a cat. But if there is a derivatives overlay that a client has requested, and we've been doing this for a long time, we've built a solution around that. Not saying there are things that we don't do or can't do, but our clients haven't demanded them as of yet. So, been in business for about 4 years, going on 4 years, and we've really kind of had an ear to the ground as to where our clients, wanted us to build strategy, implement strategy, whether it be an alpha story, whether it be a beta reduction story, whether it be tail risk hedging, covered calls in an IRA or an institutional mandate, with kind of a much different focus and mandate given kind of the tax status of those institutions.
I often joke here on the network that a substantial portion of the options industry is devoted day to day to finding ways to try to pay for their puts. That's pretty much what a lot of them are trying to do. That is the business. So what do you guys? What's your preferred approach for that? Some people like to do just the basic collar and try to structure something zero cost that obviously has advantages and disadvantages. Some people like to go beyond that. Maybe they do a put spread and also a collar. Some will do other things like that, or put spread, and a covered call. What is your preferred? I'm sure a lot of clients come to you and say, hey, I want this protection, but I don't really want to pay for it, which is probably the most common refrain we hear out there. What do you guys do for that type of client?
Yeah, certainly. So that is the common request, right? I want insurance, but I'm reluctant to pay for it, or I'm willing to pay X, but once you look in the market and you see what X is, you kind of take a step backwards. So
yeah, there's always that awakening moment. Oh, I had no idea these were so expensive.
I think the biggest thing here to think about in creating efficient portfolios, and this goes for any asset class, but derivatives specifically, there's a lot of dials. So you have term structure, the difference in kind of the implied vol between a 30-day option or a 90-day option or a 360-day option. And then you have skew, which is the relationship between the at-the-money put or at-the-money call and varying moneyness. So the way our clients really look to us is they scope out what their objective is, and then it's our job to give them what they need, and to kind of consult that out of the gate, and then in perpetuity manage that strategy. So you can create very efficient hedges, even within just kind of broad-based indices. So let's just speak to the SPX. By laddering out different maturities given the environment. We're in a fairly flat implied vol environment right now, so the term structure is not steep. Some people use backwardation versus contango, but the idea here is taking efficiencies where you can get them. So right now there's not a ton of efficiency by altering maturities unless you have a large macro view on the level of vol. But when you are constructing these hedges, putting in a long-dated put and a short-dated call for a collar in some environments, and then almost the inverse in other environments, right? So the environment will dictate the most efficient hedge.
Speaking of environment, we're in a very fluid volatility environment right now. Volatility has been spiking leading up into the elections. We are talking here a day after the midterm elections here in the old U.S. A lot of people have been speculating that was what was keeping volatility elevated, keeping VIX futures backward, at least in the near term. That seems like that was indeed the case. We're seeing VIX cash crashing, the markets rallying, VIX at the 17 handle as we're speaking right now. So I'm looking at the futures as well. The futures have pretty much lost all that juicy backwardation they had even just a session ago. So interesting stuff out there. But these are interesting times. Before we get to your thoughts on, the current volatility regime, these are interesting times to be out there kind of marketing and promoting a protective / overlay type fund. I know you had decent results in Q2. I think you guys grew your AUM by about 40%. But what's it been like now in Q3 and talking to people as these relatively higher, at least recently higher vol levels? What's it been like? Has the response been high? Usually people in these types of environments, they could be very excited to see something protective and want to go towards that, or they could be a little bit more reticent because the volatility kind of spooks them. What's the response been like as you guys are going out there kind of preaching the gospel of overlays in this volatility environment?
Yeah, sure. So, I think the volatility environment in 2018, I would classify as moderately normal. I mean, if you look at historically, 10, 20, 30, 50 years of where realized vol is for broad-based equities, you're somewhere in the 18 to 22 range, depending upon, which time bucket you're evaluating. So, realized vol right now, which is, I would say what keeps implied vols elevated, you're chugging along in the, low 20 range on some near-term stuff, and the longer-dated realized vol, you're in the mid-teens, right? So that is by no means alarming. I think the regime from 2009 on has just been so dormant, absent a few pockets, that people have become complacent. And so when you see volatility spikes that we saw in February and then recently here in October, it just makes people realize that risk is apparent. And understanding the value of a hedge or understanding the value of an overlay, becomes front and center very, very quickly. But by no means is this environment that we're in today abnormal. People are like, oh, the volatility's back. Well, it was never there for the better part of the last 10 years. So it's not necessarily that it's back. It's just it's returning to a normal state, whether it's fundamentally driven, QE, geopolitical, domestically political. I mean, there's a lot of things that go into this equation as in any financial market. But the interesting thing here is, yes, the demand for overlays is escalating. I think it's more just than the environment of volatility. It's the bull market has really been very fortunate for a lot of folks. And so if you are able to capitalize on those gains, you're sitting on pretty hefty return, and de-risking that or rebalancing in a retail construct is often prohibitive in a taxable account. So applying an overlay can be often the silver bullet to get your portfolio risk where you'd like it to be without necessarily incurring that tax bill.
And you had a nice bump in AUM in Q2. I think it was about 40%. What is AUM these days over there at SpiderRock?
Yeah, we're just embarking upon $500 million. So we're very proud and humbled by the clients and the receptivity that we've had. Market conditions definitely are providing the value prop of the work that we've done, if there's any hedging construct, especially in a month like October. But like I said, a lot of groups that are using us today didn't think it was feasible for their clients, given some of their AUM thresholds or account minimums. The institutional crowd is a different ballgame, but we kind of straddle the retail and institutional world, and appeasing the demands operationally was the biggest lift that we saw the void in the industry that we fulfilled, and so that's the recent uptick. I think is our client kind of adoption rate, so to speak.
And maybe the flip side of what we're seeing right now, this recent spike in volatility, or maybe normalization, depending on your viewpoint, is of course last year when we saw the markets effectively trending upward and volatility just got very anemic, VIX cash down to single digits for substantial periods of time. What was it like going out there and talking the gospel of overlays in that environment? How challenging was that?
Yeah, people want income, right? So they think of selling call premium as income. And when the market rallies with a low vol footprint, you're not receiving quote unquote income in the levels that you probably should. And, it is our job to kind of aid that equation and make people understand that. But yeah, I'll call it bull market overlay fatigue. How many quarters can you go with having, the so-called call away be a relevant conversation quarter in, quarter out. So yes, there was definitely, 2017 was challenging, 2013 as well. But largely speaking, for the educational component of our work, people understand this. And so if you're marketing and you're selling this properly, and as a fiduciary you're implementing it in the capacity that you have said you would do, people understand that. And at the end of the day, like that is a huge value prop that we bring to them in delivering exactly what it is we said we were going to do. So there are no surprises when these events occur.
It's funny, an environment like that, you're right, your income levels are going to be lower because, the vol is low. So people also are used to a bull market, so they don't want their upside cap, so they're fighting you on that. And then also B, they're probably calling you and saying, why are you wasting money paying for protection? Even though that protection is cheaper, they don't see it that way. They just see it as wasted money in a bull market. So I'd imagine that was challenging. These types of environments, you have a little bit of a shock to the system. That probably makes it a little bit easier for people to pick up the other end of the phone when you call them and say, hey, how about that? How about that protection? How about that overlay? We see that a lot now. It makes people, shall we say, a little bit more receptive to what you're telling them, Eric.
It is, but I'll also provide the metaphor of when your homeowner's insurance, your fire insurance renewal comes up, you're not renewing your insurance because there was no fire, or there was no damage to your home from a tornado or other inclement weather. So, that metaphor resonates with a lot of folks. But you're right. The fatigue of outlaying premium in a put capacity, and the fatigue of quote unquote having a unrealized loss turned into a realized loss on selling a short call in a bull market. There is that fatigue. But again, understanding and educating our clients, institutions and advisors alike, ahead of time, really helps aid that when it happens. But yes, the behavioral financial component of it is, I don't want to cap my upside and I don't want to pay for insurance, but the rational, objective lens from any kind of steward of capital will quickly realize that there's no free lunch.
No free lunch. I like that. It's interesting. You kind of touched on it earlier. Let's get back to it a little bit. Obviously, we're in a very fluid volatility regime as we speak right now, which is kind of interesting. You and I kind of come, I think, from the same viewpoint when it comes to volatility. We both kind of cut our teeth in the SPX pit on the SIBO, so that gives you a certain view of what normal volatility is and what to expect from things like the futures volatility term structure and from the skew and things like that. You kind of touched on it earlier, but I'm kind of curious. It sounds like you're in the camp then that we kind of what we saw last year, which a lot of people, including myself, were last year was kind of the outlier, and what we're seeing this year is more of I hate to say normal, but more regular state of volatility, and you think we'll probably be seeing these types of levels going forward?
Yeah, broad-based equity, let's just talk about it as a SPX and just call that a kind of synonymous for example purposes. But, drawdowns of 8, 10, 12% are much more frequent than we've seen in the last 10 years, right? If you look back in time, 15-month rolling calendar periods, you'd expect a drawdown like that almost every single 15-month rolling period. And so, we've had 2 this year in a shorter window of time, albeit, the October drop was a little less vicious. But nonetheless, I don't foresee this as alarming. People always ask me, are the fundamentals changing? Is it time to ring the register and cash in all our chips? Well, no, long-term investing you should not be fickle in making a decision about your long-term plan, or an institution that has, an infinite horizon, regardless of what happened in a month, right? So people have been very fortunate, almost to the point of, I would say, not really respecting the risk that they're incurring by investing in equities. And when you do get these blips, it just kind of reinforces that there is risk in investing. And that is paramount to any portfolio, but it's easier said than done when you're facing a drawdown in real time.
Yeah, and obviously we're seeing quite a drawdown in volatility right now. People were speculating for a while, including on this network, what was keeping those VIX futures so juicy, so backward. They were talking maybe it was earnings season, maybe it was non-farms. A lot of that has come and gone. We still saw that premium, so it seemed like the third guess, which was the midterms, seemed to be the accurate one. As I'm looking at the futures right now, they are no longer backward, so that seemed to be the case. Were you? It sounds like you were in that camp as well. And do you think this is kind of going to be we're going to be back into these levels for a while here, or you think maybe we have some more systemic shocks coming in the near future, getting us back to those comparatively lofty high 20s, low 30s levels in VIX land? What's your outlook near term for volatility here?
Sure. So, the market clearly got what it wanted out of the midterms, and volatility dampening is kind of also reflecting that. I think there's a few things to keep in mind at the macro level. Realized vol at the end of the day is, coupled with implied vol or the VIX interchangeably almost every single day, if not second, right? And realized vol, if it's going to persist, we'll keep a floor in implies or a floor in VIX a little bit higher than I think where people have been the last couple of years. Now, fundamentally speaking, I think there's a macro backdrop that is painting a picture that could arguably advocate for a higher volatility regime, predominantly around QE domestically. And then from a technical perspective, if you're a technician, this is not our core competency, but nonetheless, I'm cognizant of how this viewpoint takes place. You could argue that the technicals are weakening. And in that scenario, if we are beneath the 200-day moving average, volatility historically has been higher than if we've been above the 200-day average. So with that level in mind, people should be cognizant of fundamental backdrops somewhat shifting, technical backdrops maybe shifting, and so you get those two, I would say tailwinds, headwinds, depending upon which point of view you have, in motion, and you could arguably say that we're going to be having a new regime looking forward.
And do you guys offer that at SpiderRock? If a client comes to you, will you offer them your viewpoint on, let's say, traditional things like, are you bullish or bearish at these moments in, let's say, the S&P or volatility? Or is it more the client will come to you with their outlook and then you'll consult with them to help construct the proper overlay for that outlook?
Sure. So our strategy design is predominantly systematic and quantitative based, right? So these macro forces that I'm speaking to are we are observing them. We are cognizant of them. They are not inputs into our models, right? And so understanding that the macro forecast or the fundamental forecast is often dictated by our clients. And so we're scoping and shaping the derivatives component of what it is they're trying to accomplish, right? So I mentioned the first objective for us is to understand what they're trying to solve for. So somebody who doesn't have any options knowledge at all calls and puts Vega, Gamma, Theta, they're never even going to be spoken about, right? If they're looking for downside protection, if they're looking for income, if they're looking for volatility reduction, if they're just looking to reduce idiosyncratic risk in a single name and want systematic risk, all of these things are conversations that we're having, none of which have anything to do with, term structure or, the richness of what we'll call edge between an options implied vol and where we think our theoretical value for that surface should be. These are conversations that we can get into if our clients have that sophistication level. But I would say about 2/3 of our clients just ultimately highlight their objective, and then we solve that for them using our work.
And what kind of calls are you guys getting right now, in these recent market environments? Are people looking for more hedging type strategies? Or what kind of, are they saying these levels are too low? We're looking to get more bullish in the market? What kind of calls are you guys getting right now? What's the predominant trend?
The heightened level of volatility is, salivating from somebody who wants to sell option premium. And so because I would say, a good chunk of the industry, you mentioned earlier, people not wanting to pay for protection but would rather receive income to do so. that crowd really wants a kind of a refresh on where the current levels of volatility would affect their portfolio, right? And so the inbounds today are, hey, I know we've been talking about doing this for a while. I'd like to understand what the climate like today is and how that looks differently than maybe it did in June or maybe September of last year. And so we give kind of a refreshed state of the world, whether it be an S&P or whether it be an Apple options, or Microsoft or anything that's coming, from a portfolio standpoint from our clients, to revisit the landscape here and provide our best thinking as to how to, put the constructive hedge in place if that's what they're looking for.
And you mentioned Apple, the go-to for a lot of people out there in the equity space. I know you deal a lot with the broad equity indices, but you get a lot of clients calling up too saying, I want an overlay, let's say on Apple on individual names, or is it primarily the macro index focus?
Like I said, Mark, earlier, we've just kind of built our business out of listening to the demand curve from our clientele. And so whether it be mutual funds, whether it be institutions and indices, whether it be liability-driven investing, whether it be Apple or Microsoft or Pfizer or small cap biotech stock. If the demand has been there and we can build process around it and provide our best fiduciary thinking as to how to manage that process, with our competency in derivatives and financial modeling, then we've had that. So long-winded answer to your question, but we've built a process and an overlay to appease all of these things.
We've had much longer-winded answers in the past. Don't worry, Eric. That was actually pretty brief, given some of the answers we've had. But you mentioned the kind of talking about products a little bit. You talked a lot about the volatility space. I think you sounds like you play mostly in the direct vol space, aka the SPX and the index products. But do you also play in the volatility product space, the VIX futures, VIX options, that sort of thing?
VIX options, yes. VIX futures, we have a few mandates in that arena. But largely speaking, the SPX relationship with VIX relative to UX1, UX2, VIX futures, we have the way we feel is the most efficient at any point in time, the way to get the convexity profile. And so understanding term structure, understanding skew, and that relationship between the VIX is paramount in constructing that. But I would say largely speaking, most of our clients completely understand SPX. Less understand VIX, and so their comfort level for us to do our work, even in the scenarios where VIX is the ultimate or superior solution, they stick to what they know.
And what is your typical use case for, let's say, I'm assuming you're playing in the VIX calls, maybe, is that as a kicker for when the overlay is kicking in, the VIX call will kick in? Do you actually view VIX calls as a hedge? I know some people find that to be a dubious prospect. What is your view as like the proper use case for a product like VIX options?
Sure. So, like I said, people when they read the Wall Street Journal or look on CNBC and see VIX, understanding that it's not actually investable is the first piece of education. And as you go downstream into UX1 and UX...
You'd be amazed how many people still don't understand that basic concept.
Crazy,
We've been
right?
talking about it for nearly a decade. They still don't get it.
Yeah, you're long VIX. Did you make money today? Well, not necessarily. So, understanding that concept and that dynamic, and fundamentally speaking that the VIX is derived from the S&P, there is the best hedge at any given point in time from where we sit in terms of a model standpoint. And so if I have carte blanche free reign to transact, then you'll get our best thinking and the way that should behave through time. But some accounts don't allow futures, right? Some clients, even if they can allow futures in their account, don't understand the relationship. And so, like I said, our best ultimate value here is delivering the ultimate financial objective and managing that through time, but educating the pros and cons of all the different solutions that we could proceed with. And if our clients don't want us to go down the VIX path because either they're bored or their CIO or they had a bad experience and kind of what I'll say is the market path, right? So S&P drops 10%, VIX last time went up 25%. Well, that relationship does not necessarily hold in every 10% drawdown, right? And so that concept, if you don't want that ambiguity, history doesn't repeat, it rhymes, I think as the phrase goes. If you don't like rhyming because you need exact, then we need to transact in the SPX.
And what are you guys are out there, as I term it, kind of fighting the good fight, trying to preach the gospel of options adoption to a lot of firms like advisors and others. That's a thread we talk about a lot here on our network, whether it's on our advisor show or just in some of our general education programs. That's a growing audience for this industry in terms of getting asset managers and advisors on board with using even basic things like protective puts or covered calls or overlays or that sort of thing. How is that process? What's your anecdotal view of that process and the adoption rate? I know a few years back, when a firm like an OCC and their advisor team called up even a general pension fund or hedge fund or advisor and said, hey, you should maybe think about using options, the response wasn't that receptive. Fast forward a few years, and it's changed a little bit. I'm curious, what's your anecdotal view as you're out there talking about using these products to a lot of these funds? Has their viewpoint, you think, shifted? Are they more receptive, less receptive? Has it evolved? What's your thoughts on that, on the adoption rate of options for institutions and funds out there?
That's a great question, Mark. The OCC/OIC has done a tremendous job and has commissioned 2 studies focused directly on institutions in the Greenwich study and focused directly on the advisors in the Cerulli study. Those came out a year and 2 years ago, respectively. This data proves the need and the desire to use options for both categories, right? And so the crowds that have already been doing them have had the expertise. Like I said, knowing that there is a larger audience that is not using them that would wish to, and understanding why they're not is the predominant results of the study. And in the Cerulli study, which is a more retail-based study, they highlight a few things, right? Either I don't have the know-how. That was one piece of feedback. So if I had the know-how internally, I would be more comfortable in pursuing this. The second was even if I have the know-how, I don't have the time. And the third is, even if I have the time and the know-how, I have a problem scaling operationally. And so our focus was to solve all of those needs and problems as to why this audience was not pursuing these strategies, and taking all the work off of them, appeasing the operational scale and the fiduciary know-how. That is our business, right? On the institutional side, a lot of them have investment teams. They may or may not have investment teams in derivatives, right? And so the build in-house versus outsource equation is always on the doorstep of every institution, right? And the institution needs to have the scale internally in their own mandates and their own AUM to justify an in-house team. But regardless, those mandates have grown. I think this study was, in upwards of 400% in the last 5 years, right? So the IPS, the investment policy statement many moons ago, prohibited the use of derivatives. Well, understanding that our climate is changing from, having fixed income yields be depressed for so long, granted they are rising as we speak, but longer, term mandates to include these strategies, I think, is relevant, right? The Sharpe ratio focus, understanding that efficient portfolios have diversification and have a focus on volatility management can really, augment, the longer term results, right? So if you look at a pension, some of the underfunded pensions, and how are they going to get back to being fully funded, the glide path and the predictability of derivative strategies aids that equation a lot. And so once the education is done in this arena, and once, I would say, a few of the industry leaders have taken I won't even call it leap of faith, because historically speaking, they should have been always doing this, in my opinion. But once the broader adoption takes hold, there will be followers, right? So fighting the good fight, the whole industry has been kind of preaching to the choir as to the merits and the efficacy of these strategies. I think it's taking hold, and I think 2018 highlights it.
Well, Eric, this has been a fun, very far-reaching conversation. But that said, if you're kicking yourself, there's something you forgot to mention earlier, or maybe you want to leave our audience with maybe a little bit of a hint, a little bit of a tease of what they can expect from you guys at SpiderRock in the coming months. Now's the time, sir. The floor is yours.
Yeah, sure. No, well, once again, Mark, appreciate the time and the invite to your show, and very impressive audience and business that you guys have built here. I think largely speaking, the macro climate is always fluid, and geopolitics, domestic political conversations, and then fundamentally and technically speaking, the markets are dynamic and they're shifting, and a few phrases have always resonated with me, and that's hedge when you can, not when you have to. And the market will always stay irrational longer than you can stay solvent. So those two things, and understanding that predictability and derivative strategies can aid both of those equations, I think are prudent things to think about when you're building your portfolios.
And Eric, if people want to learn more about what you talk about here, maybe want to learn a little bit more about SpiderRock, maybe they want to reach out to talk about overlays, where should they go? What should they do?
Sure. Our website, I think, does a decent job in articulating, our business and our value prop, www.SpiderRock Advisors, that is plural with an O, .com. And, myself or anybody on our team, can aid any inquiry.
Well, Eric, we appreciate you coming in and giving us a little bit of glimpse into SpiderRock. I got a feeling with all this volatility, or maybe today lack thereof in the marketplace, you and I will be talking again sometime in the near future, sir.
I appreciate it, Mark.
All right, and thanks for joining us, and we'll see you again real soon here for more episodes of Options Insider Radio.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.